Welcome back, my friends. Today I'll be sharing on how I made $10,000 in Tesla options for the past 3 months. But first, let me put out some disclaimer. This is an experiment based on my theoretical knowledge that I'm putting into practice. It is more of a journey of trials and errors rather than a fully back-tested system. There will be full transparency on my mistakes and the right things that I did for the past 3 months of doing Tesla options. I hope that by offering transparency on the mistakes I've done, it helps to lessen your mistakes in the future. This video will be focusing more on the mistakes because that's the more important lesson. If you're new here to the channel, welcome. This channel is about a 26-year-old guy wanting to solve a problem of financial illiteracy of this generation. And this channel will be dedicated to help more people build wealth. If you would like to support our work of educating you guys on finance and investment, do smash the like button and subscribe to our channel. Thank you. I believe that accumulating wealth is how much value you bring to the world. You'll be compensated based on the value or the importance of the work you do. Creating value or being valuable is all knowledge gap. You have to continuously improve on yourself to close up the knowledge gap. So in the investment world, understanding options and how it works is part of closing up the gap. I'll link a video up here and down below for you guys to check it out of what I'm going to talk about. Those who supported this channel knows that I'm very bullish on Tesla because there's zero competition to Tesla. Nobody is close to producing a AEV, which stands for Autonomous Electric Vehicle. Tesla is a fixed cost business where expenses will not increase much and the vehicle produced will keep increasing, which translates to revenue. Batteries are the key component of building an electric vehicle and also the main cost of building one. The cost of building electric vehicle will go lower and lower with economy of scale and Tesla's innovation. So with revenue growing higher and higher and expenses dropping lower and lower, we just need time for Tesla to show its insane operating profits. Tesla is also the only company that can sell you a $10,000 software with full self-driving. The profit margin for software is much higher than producing hardware. Now that we understand and summarize Tesla's fundamental, so we look at the technicals and understand that the low 600 is a consolidation zone and acts as a good support. And I'll link a video up and down below of what I've previously covered on Tesla's technical chart. In consolidation, it's like the bulls and the bears are playing a tug of war, and it will take a significantly long period of time to decide the winner. Understanding the fundamental of Tesla, knowing that with time, Tesla will eventually scale, the direction is clear to me that after this consolidation phase, the bulls are going to win. So there will be a period of sideways moving for Tesla. And as an investor, what can you do with all the spare time while waiting for Tesla to go up? Okay, listen here. This is the important part. You can extract time decay from Tesla and use that profit to purchase your Tesla shares while the market are moving sideways. So what do I mean by that? You can do a sell-put options, telling the options market that you are willing to purchase 100 Tesla shares at your desired price, let's say 30 days from now. So irregardless of what happened, you are guaranteeing that you will buy the shares 30 days from now. So for doing that guarantee, you are bearing a risk and you'll be paid some money to bear this kind of risk. The money paid to you is called premium. The premium is calculated by intrinsic value plus time value. Let's say Tesla's price is $650 and you sold a put option at $640. You will not receive intrinsic value from the premium, but what you receive is time value. So the opposite applies if you sell a put option higher than $650. You will get both the intrinsic value plus the time value of your total premium. So for example, today is 27 July, Tesla is at $657 and I guarantee to buy 100 shares 1 month later. I'll be paid a premium of $38.40 per share, which translates to $3,840 USD for 100 shares. The best case scenario for me is Tesla goes above 657 and I get to walk away with the full 5.2k SGD or 3.8k USD for free. So my worst case scenario is if Tesla goes way below 657, I have to guarantee to buy them at 100 shares for 657. But because of the premium I've received, it can be used to offset the cost of purchasing the shares. Hence, the worst case scenario I'll be buying them will be at $657 minus the $38.40, which is $618.60 per share. Okay, so let's quickly cover my previous trades and most of which is mistakes that I actually embarrassed to show, but thankfully I could recover from the mistakes and even profited $10,000 SGD. So at April, Tesla rallied to $770 and fell back to $700. So I felt confident and I sold a put option at $705, guaranteeing that I will buy Tesla share at $705 on May 20th, which is 1 month away from April. For that, I received a premium of $53.30. So the worst case scenario for me will be I have to pay for $651.70 per share for Tesla. So Tesla price crashed in May to around $560 to $580. I was forced to close the put option at a 7k loss because I'm paying for $651.70 per share when the price is at $580. So what I did to prevent the 7k loss was that I bought more time to be right. And I opened another put option selling at the same strike price for another month, receiving premium to offset the loss. My mistakes here was that I put my optimistic bias on the short-term outlook, which short-term is something that I cannot control. So what I could have done better was removing the bias, sell a put option that has higher probability of being correct. So for example, selling at a strike price of 640 versus 705, collecting lesser premium, which also protects my downside risk. So if you think I'm stupid, just trust me, this is not the end. The first put option was a cash covered put, meaning to say that I have the collateral and I'm on no leverage. I sold a second put option 2 weeks later when Tesla dropped to 680. Again, with my optimism of Tesla have influenced my decision making at hindsight. So this time is worse. I didn't have the full cash to do a sell put and I'm on leverage this time round. So same thing, I sold a 680 strike, premium of $56.20 and break even of $623.80. I closed the put option when Tesla is at $595, absorbing a $2,786 loss. And I reopened another sell put option at the same strike price, $680 for the next month, buying more time to be right again. I was faced with over-leveraging problem like margin calls and I have to top up cash to my account. This is very bad and I put myself in unnecessary stressful situation back in May and June. So I hope by openly sharing these lessons, you don't repeat the same mistakes as me. When you close the put option and open another put option for the next month, you are receiving the premium still. You are just buying more time to be right. And the market can continuously prove you wrong and even go downwards more. So knowing that, my priority is to close one of the two put options as soon as possible so that I don't have to deal with leverage and margin call issues. Let's tackle one by one because I have two different put options going on at the same time and it gets confusing. To sum up, for the $705 put, I closed at a loss of $7,000 first month and I roll it to the second month. So Tesla started recovering and I'm up 3.9k but still absorbing some losses. I continue to close and open another put, we call it rolling, and I roll another one to July 16 at the same strike price. In the end, I closed it for a 5.8k profit. So for the $680 sell put category, the same thing, I roll the losses until I eventually become right. My priority, however, was to remove my leverage. Hence, I closed my positions early for the 680 put. Even though there's a chance that I can profit higher, I prefer to sleep better. So here's my 680 put over the course of 2 months. I'll put it somewhere here. And this is the total profit and loss of all put options over the course of these 3 months. The net profit is US 7.7k, equivalent of 10.5k Sing. The key takeaways are that you should understand options and use the various different strategies to protect your risk. There are strategies such as Iron Condor, long vertical spread that I advise you guys to check it out. If you are able to close up this knowledge gap, you can put your capital to good use. So the mistakes we should avoid are biasness that will affect your judgment when it comes to selling put option. Because option is a probability game, it is leveraged because you are using lesser capital for 100 shares. So your judgment must be accurate and precise. There is lesser room for error and patience is key. Try to never use leverage. When shit happens, your entire portfolio goes down together because it is tied to the price of the assets you are holding. When assets go down, margin requirement goes up. And margin call always happen unexpectedly. So sleep better to fight another day. So after knowing all this, I have an ongoing Tesla put option now, which I patiently waited for a red day when Tesla is $620 and I sold a put option at $610. The trade is live now and I'll update it when I close this trade. Selling put option correctly can add on to your income. So just imagine if I paid 4k a month for your work and selling a successful put gives you 3k a month. Your net income becomes 7k a month now. I hope this opens up your perspective of things and there are many other ways to add on to your income. But most requires the capital to do it. Hence building your capital is very important. I hope you learned something from my mistakes and going forward we all become a better investor together. So don't forget to like and subscribe to my channel. I will see you next week.